The owner of this company wants these things from his company within 5 years. He presently makes $75,000 annually, which you will see in a minute, but he wants to grow that to $250,000. He wants to enjoy a lifestyle where he is only going into his office 3 days per week, and his company affords him to take two-week vacations throughout the year with his family. He also would like to know that he could sell his company in 2020 for $7.5 million. Sounds like a pretty good reason to start a business, doesn't it? This is a nice list of goals that you don't normally get to enjoy with a job. And frankly, not many enjoy these benefits with a business either. So let's see how he plans on making this a reality. To enjoy these things, he needs to consider a few things. His organization must be of a certain size, be structured in a certain way, and needs to be doing a certain volume. And this worksheet shows us all that and even more. This first worksheet starts off showing us 3 organizations. We get a picture of what his company's organization looks like now. In your case, even if it's just you, we start with that. In his case, you can see that he has a modest organization of 11 people doing just under $900,000 in sales. And for him to achieve his 5-year objectives that we just saw on the previous worksheet, this is the organization that he believes he needs to create in the next 5 years. This will require some impressive growth, and it will take some planning. I'm sure you agree. It makes sense that if he wants to work only 3 days per week and take 4 weeks of vacations, he had better have a healthy infrastructure of capable managers in place, and you can see that he does. And since he is interested in selling this company at some point, he will really have something of value here. Finally, we had him draw out the organization that he needs in the next 12 months to move 1 year closer to his 5-year organization. This organization grows to 19 people, and his revenues will grow to $1.1 million. This becomes a very visual 12-month goal that he must achieve to be on track for his 5-year plan. To make this organization possible, you might agree that his revenue growth becomes the next most important focus. So let's flip over to the Revenue tab and see how he does it. Don't you agree that revenue growth is much more believable when you see it compared to past performance? Here, we go back 3 years, and you can see exactly what his sales were and where they came from. He had the same 3 offerings as he does today, and you can see here how each of his 3 offerings contributed to his total revenues. Across the bottom, you can also see how seasonality affected when his sales were earned. You can see that his business has been declining over the last several years, where his sales fell 4.7% in the following year, and then another 2% the year after that. He has responded to his declining sales by becoming more assertive in his growth plans. And you can see this year that he is planning an overall company growth of 25.5% to the $1.1 million we saw earlier. But doesn't his $1.1 million have more context now that you see the bigger picture of his past performance and how much growth is actually required? We also see how each of his 3 offerings must perform to make his company's sales possible. As we move through his control panel, anytime you see a pinkish colored cell, you can change the information in it to get a different planning result. All other cells are automatically calculated based on what you put in these pink cells. For instance, you can see that last year this offering created 21.1%, and this year it is only forecasted to create 18.2%. Let's say that he would rather work to keep these 2 services in the same proportion as his company grows. To do this, he can simply increase the forecasted growth of this offering, let's say from 20% growth to 45% growth. And you can see that this offering will then contribute 21.3%, which is more in line with last year. You can also see that by increasing this percent, his total sales forecast grew by over $42,000. This change would have moved his total percent increase to over 30%. You can play countless what-if scenarios until you and your team are happy with your total sales projection, as well as with your mix of sales if you too have multiple offerings. You will also see his seasonality is automatically calculated across the bottom with every change. Now, if increasing his revenues was the most important factor for him to grow the organization we saw on the previous worksheet, what will be the most important factor for him knowing he can actually produce the increased sales? It is his labor force. And labor has always been one of the most difficult things to plan for, until now. This next worksheet allows him to see his labor plan per person, per department. His direct or production force, his fixed or office support staff, and his commission-based compensation, or his sales force. Starting on the left side, you simply add the names of your present labor force personnel. Next to that, you input the hours you anticipate they will work, and next to that, their wage rates. Easy enough. You can then see that his future employees, numbers 11 through 15, are not hired yet, and until they are brought on, we simply put zeros in these months, or until he hires them. This makes the very next input very quick as well. How many employees he is planning to have for each month of the year. You can see here that he starts the year with 10 and grows to 15 by the end of the year. Dropping down to the next input, you can see how much he charges each customer per hour for each man on a crew. His present charge is $45 per hour. The next input is his crew's efficiency rate. This was quickly calculated by having his foreman record his crew's downtime, or in other words, how much time his men are on the clock but are not billable to a customer. This is time spent at the shop, traveling, lunch breaks, and so on. In this case, his crews had about 2 hours of downtime each 8-hour day. By dividing 6 by 8, you get 75%. So that makes up his efficiency rate, which he put here. Do you know why it is so valuable to track this information that you might never have seen before? When you see it, you can improve upon it. It's really difficult to improve upon that which you never see. With his final input, an important calculation is made. It tells him the efficiency and affordability of his labor plan. In this yellow cell, we will see the amount of overtime that will be required to produce the revenues he is planning on, given his hourly rate and his efficiency rate. Wow! 17% of his total payroll will be paid out in overtime. That comes up to over $76,000. It would appear that his labor plan is not very efficient. Most companies cannot make money paying out that much overtime. So how can he become more efficient? Efficiency is comprised of these three components: how many people he employs, their hourly rate, and their efficiency rate. The ideal solution is seldom going to be in just adjusting one of these three components. The ideal solution will likely be found in optimizing all three. And this is what the control panel allows you to do throughout all the worksheets. Find the optimum balance of your business's working parts so you gain control over the outcome. Let's say that he considers increasing his hourly rate that he charges his customers by 9%, or by $4 per hour. You can see that he can also make seasonal adjustments to his charges if he wants, but we will make it an annual change to $49 per hour. By making this one change, his overtime dropped $30,000 from $76,000 to $46,000. Well, if his customers accept the increase, he is on the right path. But what else can he do with these two other components? Let's say that he sends his sales force to sell in areas where he already has jobs, so his crews are not driving so much. And let's say that by doing this, they decrease his daily travel time on average by a half hour. His efficiency rate climbs to 81%, and his overtime drops from $46,000 to under $26,000. We can now see that most of his overtime is coming from the first half of the year. To be more efficient, he can experiment with adding a few more workers to these months. Keep an eye on his overtime hours reflected here, as he increases his workforce in the first half of the year from 10 to 11 in month 1, and then in month 2, he bumps it to 13, and to 14 in months 6 and 7. He still ends his year with 15 employees, but he simply needed to add some additional help a little sooner than he thought. And as you can now see, he dropped his overtime to a manageable 1.8% of his total payroll, just about as close as someone might expect to get in the planning stages. Scrolling down, he would like to start offering health insurance to his workers, but he wants to do it responsibly. We will come back to this what-if scenario at the end to see the pros and cons of his decision. And finally, he can see that his total direct costs are forecasted to be 26.2% of his revenue, which he can compare with previous years to make sure his labor is not getting out of control. The exact same process is repeated in his fixed and commission-based compensation categories, so we won't take the additional time doing that here. Even though labor is the most challenging thing to plan for, there are other things to consider as well. On the Budget tab, you will see his forecasted revenues across the top, so his total sales reflect the 1.1 million we saw earlier. We have two other important lines here in addition to his sales. It is often difficult to tell salespeople to go sell $200,000 in additional revenue this year. What does that really mean, and what is exactly required to do that? But since he knows that his average job is $3,500, we can see each month how many actual jobs his salespeople will need to sell to create that $200,000 in new revenue. As he completed the budgeting process, you can see that his bottom line profit is now 22.7%. But why is the marketing expense line not filled in? Because we don't know yet what marketing activities are required for him to hit his targeted revenues. And hitting his targeted revenues is all important to making this annual plan work. And this is where the next worksheet comes in. Here, we learn to master the 7 variables that affect the success of a marketing plan. If you don't know what the 7 variables are or how to control them, your marketing success will be greatly limited. The first 4 of the 7 variables are seen here in the Inputs section. As you can see, none of these are in pink cells. That means they are imported automatically from work done in other worksheets. His average price per sale is imported from his budget. His gross margin is also imported from his budget. We see 2 very important conversion rates, from lead to presentation and from presentation to sale. We will see where these conversion rates come from in a moment. The 5th of the 7 marketing variables is the actual marketing activity he chooses to engage in. The 6th variable is how many leads each activity is predicted to create, and the 7th variable is the marketing message that will accompany each activity. Here he is able to test every marketing activity that is available to him. He is able to test what he can afford to budget for each. It challenges him to think through how many leads each activity must create for him to make money, and with that information in place, he can simply look down here to see if each activity is indeed going to make him money. Let's see how it works. He has already been engaged in 3 marketing activities: a referral campaign, an online program, and a radio campaign. And since we asked him to track it, he knew the inputs of his actual expenses totaling $3,500 and his lead generation total of 95 leads per month. Given his inputs for these activities, his cost per lead was $37. That was a real wake-up call for him. In essence, every time his phone rang, he paid $37 for the privilege to hear it ring. But as we follow the worksheet down, you can see that due to his 75% conversion rate from lead to presentation, his 2 salespeople were scheduling on average 74 presentations each month. And due to their 30% close rate, they were making on average 22 sales. And since we know that his average sale is $3,500, it is easy to calculate that his company's total sales for the year at his present rate would again be just about what they were last year, just under $900,000. But his plan is not to be where he was last year, as you remember. It is to grow to $1.1 million. So clearly his marketing plan is not finished. He needs to close the gap between where his sales are now and where his budget needs them to be. He can do this in any of 3 ways. He can improve his conversion rates, which will help his salespeople to sell more given the same number of leads. He could choose to invest more into his existing marketing in hopes that by doing so, they will produce more leads. But let's say that he chose a 3rd option, to begin a new cable TV campaign. He wanted to test a budget of $3,000 per month, making it the most expensive of his marketing activities. The big guess now is how many leads will this new activity create. He chose to start with a conservative guess of 10 leads for the first month and have it increase over time as the activity got more traction in the marketplace. We now scroll down and see that his total marketing plan revenues are just over his budgeted revenues of $1.1 million. We can also see that each of his marketing activities are producing a positive return, with all of them combined producing a 494% return on investment. Not bad. But in addition to everything else, let's see what more this exercise can tell us. Let's say he is just now sitting down with a salesperson who wanted to sell him the online marketing activity for $1,000 per month. In the past, as these salespeople started getting him excited about their offering and telling him how great it would serve his business, he had no way of knowing how well their activity had to perform to make him money. Here is one of the most important tools any business owner can have. the break-even point analysis. In the medical field, the commitment is to do no harm. In business, I suggest the commitment must be to don't lose money. And to know how not to lose money, we must first know what our break-even point is for each investment. Let's explore his. If he invests $1,000 on any marketing activity, if his inputs stay the same, he must generate 3 leads per month to break even, as we see here. That is some powerful knowledge. This gives him so much more power in any negotiations with a salesperson because he knows exactly where his break-even point is. He is now in a position to make salespeople prove that their marketing opportunities can actually produce to the level that they need to, versus him trying to figure out in a vacuum if it's a good deal or not. When this worksheet is complete, and he sees his marketing plan revenues have equaled his budgeted revenues for the year, and he has done so profitably, he goes back to review his company forecast to make sure that his marketing budget works there as well. We can see that his marketing budget has been automatically imported, and it is going to be 7.1% of his sales. And now his budgeted annual profits fell from 22.7% before he went through the marketing exercise to 15.6%. The next several worksheets are management accountability reports. The first of them is the marketing calendar. It is automatically populated from his work on the marketing plan, with the exception of who is responsible for each activity and when each of them will be executed, which can be either for an ongoing basis or for just a period of time. We can also see his actual results compared to his anticipated results, both of which are automatically imported as he completes other worksheets. The sales report worksheet shows us where the sales conversion rates of 30% and 75% came from that we saw on the market planning worksheet. Since those who answer the phone are now required to ask how the caller heard of their company, it is easy to fill in this lead tracking information. He also now tracks which leads convert to a presentation and how many of them convert into a sale. Do you remember when I said earlier that it's really hard to improve things that you are not tracking? This is another great example of how tracking something so simple can dramatically improve the efficiency and profitability of your company, and of course, increase your control over your company's results. The production worksheet reports how efficiently his company is turning sales into profits. As you can see, there are no pink cells in this worksheet, and that means it is completely populated for him. This worksheet, as all these reporting worksheets do, give him the ability to hold people accountable for the performance that he needs. The balance sheet worksheet is required to consider all the different scenarios for how a company can grow over the next 12 months. He may want to add more production capacity, take on debt, or increase inventory. Everything that affects a company's planned growth must be accounted for, and when you do, it allows you to see what is on this next and most important worksheet, your cash flow. It is one thing to create a plan that generates profits. It is entirely a different thing to create a plan that generates cash. Here you will see, month by month, where your cash is coming from and where it is going. Won't that be nice? In the case of this business owner, you can see that he started his year with $10,000 in cash in the bank. This is a simplified balance sheet that only shows certain important outputs. The next few balance sheet items are how fast his accounts receivable are turning over. Let's say that he gives his customers 30-day terms, but since no one in his office is making collection calls, his customers are in the habit of paying in 40 days instead of 30. But let's say that he is faithful to pay his bills on time in 30 days, which is what this number reflects. He also has a small inventory that turns over every 32 days. His planned growth to $1.1 million is going to require him to expand his fleet by 1 truck in month number 3. It will cost him $30,000, and he will plan to put up $5,000 as a down payment. He started the year with 2 loans, a B of A bank loan and a line of credit balance. When he buys his new truck in month 3, you can see a loan balance appears in the same month. Now we turn to his cash flow tab, and you see the company's lifeblood and how it is flowing. If you remember from the balance sheet, he started the year with a $10,000 cash balance. You can also see when we turn back to the budget, he is planning on a profit of 15.6%, which equals about $171,000. So if he started the year with $10,000 and he profited $171,000, How much cash should he have at the end of the year? Almost everyone will respond with the same answer. 10 plus 171 equals 181. So why does his ending cash reflect a balance that is only half of what we expected? And the answer, of course, is that most of it is tied up on the balance sheet. Let's take a look at how valuable having a working knowledge of the balance sheet can be for a business owner. We could review every single item on his balance sheet and find ways to free up cash for this guy. But let's only focus on two. Let's say that he gets aggressive with his receivables and decides to make his payment terms from his customers 25 days. And let's say he hires someone in his office to make collection calls on the 26th day, so he trains his customers to be prompt with their payments. Let's also say that he establishes agreements with his suppliers to pay them in 35 days instead of 30 days. Now, these business owners are obviously not managing with a control panel if they would agree to this. And now let's see what such a modest approach could look like in his cash flow. Now, instead of having $97,000 as an ending balance, it is spiked up to $144,000. But consider this. He did not grow his company larger to create this additional cash. He did not become more profitable to create it. He simply managed an asset on his balance sheet that before this he didn't even know he had. What a difference. The last tab is called Goals. It is the ultimate accountability tool that allows him to finally know for sure that all his planning was not a waste of time. Here he discovered exactly who must do what and by when to make his plan a reality. He simply revisited each tab with his team, and, as a group, they decided who would be responsible for creating the results that were reflected on each tab. By the time he got to this point, and his team saw what the company's performance could be like, they were more than willing to step up and take on additional commitments because there was something in it for them too. He could go back and tie in bonuses for his team, and all sorts of rewards based on their performance. Well, as an example, do you remember when I mentioned that he would like to pay health insurance if his company could afford it? Would that be an incentive to get everyone to perform? Let's go back and take a quick look at what it would mean. By going back to the labor plan and putting in some insurance costs for group health insurance and dental in all three departments, we can quickly size up the impact on his company. All new ideas should be tested for how they will impact the three key categories in your control panel: their impact on your revenues, your profits, and most importantly, your cash flow. Adding insurance will not impact the company's revenues, but we know it will impact his profits. You can see here that his profits fell from 15.6 to 13.3, a 2.3% drop. Is that a fair trade? It's still too early to tell. We don't make decisions based on profits alone. More sophisticated business owners make such decisions on cash flow. And in his control panel, this information is readily available. We can see by adding insurance that his cash flow fell from $97,000 to $73,000. That represents a $24,000 decrease in his annual cash flow. A 2.3% drop in profits doesn't sound as intimidating as a $24,000 drop in cash, does it? Regardless what he decides, he now will make the decision with his eyes open. He can now make the decision while asking his team to perform at a level that makes the additional benefit affordable. And he now makes the decision while experiencing a level of control over his future that he never had before. That is why we call it the control panel.